Everyone wants to build a reliable source of passive income, especially in today's highly volatile and fast-moving financial world. Social media feeds are completely flooded with self-proclaimed gurus promising easy wealth while you sleep, with zero effort required. They constantly showcase flashy luxury lifestyles, expensive cars, and supposedly effortless capital-generating income streams. But as a chartered accountant, I prefer to look strictly at the audited numbers, and those numbers paint a very different picture. The hard truth is that the vast majority of what people advertise as passive income is actually incredibly active in practice. In this comprehensive masterclass, we will pull back the curtain and analyze the actual accounting realities of long-term investing. We will systematically rank the most popular passive income strategies using a highly disciplined institutional financial framework. By the end of this video, you will know exactly which wealth-building strategies are truly worth your valuable time and capital. Let's begin by defining what passive income actually means under professional corporate accounting standards. Under strict standards, passive income is cash flow generated with little to no ongoing personal effort after the asset is established. The most critical phrase in that entire definition is little ongoing effort. It absolutely does not mean zero daily work. To truly understand this, think of building a passive income stream like planting and cultivating a physical fruit tree. You must spend years watering, protecting, and caring for it before it can eventually bear fruit with minimal effort. If you expect to harvest a bountiful crop without doing the hard upfront planning work, you are setting yourself up for financial loss. Let's first address the most common dividend investing myth: the belief that quarterly dividends are completely free money. A massive number of beginner investors believe they can simply buy high-yield dividend stocks and immediately retire. However, from a balance sheet perspective, a dividend payout is merely a cash distribution of a company's retained earnings. When a company sends cash to its shareholders, its cash assets drop, and the share price mathematically adjusts downward by that amount. In essence, you are simply taking capital out of one company pocket and placing it into your personal investment pocket. The real compounding value of dividend investing comes from owning highly profitable businesses that consistently grow their earnings. Now let's move on to the second highly popular strategy: real estate. Is owning a rental property truly passive in nature? A lot of real estate course creators claim that rental properties represent the absolute gold standard of passive cash flow. But anyone who has ever actually owned and managed physical real estate knows that the day-to-day reality is extremely demanding. As a landlord, you must constantly manage tenants, deal with property maintenance, pay insurance, and handle unexpected vacancies. Unless you hire a professional third-party property management firm, your rental is essentially a demanding part-time business. And hiring a property manager to take over these daily headaches will instantly reduce your net operating margins by 10%. Let's turn our attention to a strategy that has exploded in popularity recently: generating premium income from options. Selling covered calls or cash-secured puts is frequently marketed as an easy way to collect high-yield passive cash flow. However, professional options trading requires continuous active monitoring, macroeconomic analysis, and strict risk management. You must constantly analyze options chains, adjust strike prices, roll contracts, and manage your overall portfolio delta. From an accountant's view, option premium is not free cash. It is direct compensation for taking on significant market risk. If the underlying stock price moves sharply against your position, those capital losses can easily wipe out a year of premiums. So, what is the single most passive and reliable investment strategy available to the busy working professional today? From a strict accounting and efficiency standpoint, the superior answer is highly diversified: broad market index ETFs. By purchasing a single low-cost index ETF, you instantly acquire fractional ownership in hundreds of world-class corporations. With index ETFs, there are absolutely no physical properties to manage, no options chains to monitor, and no individual stocks to track. You simply set up automatic monthly contributions, automatically reinvest your dividends, and let the system do the rest. Over long periods of time, the compounding power of the broader global economy does all the heavy lifting for you. To help you evaluate these various income channels, we have designed the Accountant's Income Evaluation Framework. We systematically rate every single strategy across 4 critical dimensions: time required, capital needed, risk profile, and skill level. While direct rental properties score high on potential returns, they also demand immense amounts of upfront capital and personal time. Options require constant high skill and risk, whereas broad market index ETFs require absolutely zero daily effort from you. This framework helps you objectively allocate your investment capital based on your personal lifestyle, risk tolerance, and long-term goals. This logical analysis brings us directly to the single biggest misconception people have about building passive wealth. Beginners often mistakenly believe they can jumpstart their financial freedom journey by focusing solely on passive income. But in the real world of finance, passive income is almost always the hard-earned result of years of consistent active work. You must first maximize your active career earnings, live disciplined below your means, and consistently invest that savings surplus. The productive assets you systematically accumulate during your active working years eventually fund your passive lifestyle. Remember, true passive cash flow is the hard-earned reward at the finish line of your wealth journey, not the starting blocks. To summarize our masterclass, you should always avoid risky shortcuts and focus on acquiring highly productive business assets. Be extremely skeptical of any online promoter promising effortless passive wealth with zero upfront capital, skill, or labor. Building real generational wealth is a slow, methodical, and highly disciplined process that cannot be rushed overnight. If you want to master the real numbers, financial statements, and math behind successful investing, subscribe to our channel. Subscribe to The Accountant Investor, and let's continue analyzing the global markets through the clear eyes of an accountant.